Hi, good morning, everyone. Thanks for joining us on our Phillip Security Weekly morning call. Today, we have quite a few stock counters, such as Spotify, Meta, Apple, and also some technical analysis, while ending it off with our Singapore banking outlook, as well as FOMC highlight and our usual Singapore Weekly. Without further ado, I'd like to hand over the time to John to talk about Spotify. Thank you.
Thanks, Sean, and good morning, everyone. So we'll begin with Spotify's fourth quarter 2020 results, titled Margin Expansion on the Horizon. So in terms of results for the fourth quarter, revenue and PATMI were roughly in line with our expectations, with fiscal year 2022 revenue at 98% of our forecast, and net loss of about 140 million euros less than our forecast. Some of the key highlights, total MAU and premium subscribers, which are MAUs are monthly active users. Both of these numbers actually beat guidance by quite a bit. At the same time, gross margins also beat guidance marginally. So in terms of subscribers, so premium subscribers actually grew by 10 million, which was 3 million more than what the company actually guided for. In terms of MAUs or monthly active users, this number hit 489 million, which was a record 33 million new users for the quarter, and it was 10 million above guidance. So in terms of year-on-year growth for MAUs and subscribers, MAUs grew 20% and subscribers grew 14% year-on-year. So this comes, I guess it is showing some sort of validation for the company's continuous investments in its content and platform improvements over the last several years. In terms of gross margins and operating losses, gross margins came in at 25.3%, 0.8% above guidance. This was primarily due to lower than expected content spend and as well as continued growth in its core music business. So the lower than expected content spend is mainly because, like most other tech companies, Spotify has begun to kind of slow the pace of investments and control their expenses moving forward. In terms of the negatives, operating expenses growth is expected to slow, but it's still actually growing a lot faster than its revenue. So it's growing at 44% year-on-year for the quarter. And this is mainly driven by higher headcount costs and increasing ad spend. So they were actually, unlike other companies, they were actually hiring more and spending more on ads as they were building out and expanding their platform. So this has actually slowed a little bit from the third quarter. So in the third quarter, operating expenses growth was only 65%. So 44% down from 65% is good, but at the same time, revenue is only growing at like 19%, right? So this kind of has to change moving forward. And it is expected to slow quite significantly because they actually mentioned in their earnings call that they'll be cutting about 6% of their headcount in the first quarter of this year. At the same time, they're also reducing their investments and also shifting this focus into profitability, I guess away from a very hyper-growth mindset. Next slide, please. Moving on to the outlook and the guidance. Spotify actually guided revenue growth to be about 17% for the first quarter of this year. MAU and subscriber growth is about 18 and 14% respectively, with gross margin of about 24.9%. So it's down slightly, mainly because there's expected to be some sort of drag, severance-related drag for this quarter as they start laying off some employees. In terms of our valuation, we actually cut our fiscal year 2023 PATMI revenue by 8%, as well as we actually increased our gross margin assumptions to 26.8%, just mainly due to expanding margins as they spend less on expenses. We actually downgrade to an accumulate rating with a raised target price of $128. One of the reasons why we downgrade is mainly because the stock price has moved quite a bit since earnings. But we do still think that revenue should remain quite stable for Spotify because most of its revenue is on a recurring basis, like your monthly subscription. And their churn levels have remained relatively stable for the last few quarters. So that's all for Spotify. I'll move on to Netflix. Meta. The title of Meta's report is Getting a Grip on Expenses. Next slide, please. In terms of their fourth quarter results, revenue actually beat expectations by 3%, and adjusted earnings actually beat by 58%. So what I mean by adjusted earnings is that the company actually had this $4.2 billion restructuring charge. A lot of it was due to downsizing of its data centers. And we kind of took it out because it's just a one-off charge to make it a bit more comparable. And in terms of the fiscal year 2022 revenue and adjusted PATMI, this came in at 101% and 114% of our forecast. In terms of the positives, there were two main positives. The first was revenue beat, mainly due to a slightly higher holiday sales, as well as continued user growth. So even though it outperformed our estimates by 3%, it is actually still down about 4% year on year. So not really a great sign for Meta right now. But the interesting thing is that actually they are multi-active people, which is basically their active users on all its platforms, so Facebook, WhatsApp, and Instagram. This number actually increased 4% year on year to 3.74 billion. Although growth has slowed a little bit, it does seem like it will still at least move by low single-digit percentages year on year moving forward. Secondly, during the call, Meta actually placed a lot of emphasis on controlling its expenses moving forward. So it's going to focus a lot more on margins, as well as revenue. But the main key things is it's actually going to be reducing its capex by quite a bit. And they're going to do this by improving some of its data center architecture to be more flexible and cost effective. Secondly, they're also going to be slowing their headcount growth. As it mentioned that they're actually going to be leaning out some of their management layers. So we should expect some form of layoffs to continue, at least a second round. And thirdly, they're going to be focusing on leveraging AI to improve efficiency as well as video monetization moving forward. So these kind of cost cutting or rather margin contraction or margin expansion measures should actually help to provide immediate respite from its shrinking margins, which is something that has been quite a concern for investors over the last year. We've seen net margins grow from like 30+% to 20%. In terms of the negatives, near-term digital advertising demand is still expected to remain weak. And this can be seen in their soft revenue guidance of about 2% year-on-year contraction. So they actually gave a guidance range of 26 to 28.5 billion US dollars for the first quarter of 2023. However, growth is expected to expand throughout the year. And this should come as Reels, which is their short-form video platform, Reels monetization, as well as advertising performance continues to improve as they leverage AI. In terms of the outlook, Meta guided to fiscal year 2023 total expenses guide of around 89 to 95 billion US dollars, which represents about a 5% year-on-year increase, which is actually quite good because total expenses actually grew 23% in fiscal year 2022. So this has come down from 23% to 5%. In terms of capex for the year, this range is expected to be about 30 billion to 33 billion. Sorry, there's a typo here, not 303 billion, which is roughly flat or down 1% year on year. Like I mentioned earlier, they're going to be focusing a lot on leveraging its AI and specifically generative AI to improve video monetization. In terms of evaluation, we actually cut our fiscal year 2023 revenue by 13%. But at the same time, we also reduced our capex and total expenses forecast by 15% and 19%. We do forecast a 9% increase in EBITDA margins over the next couple of years, mainly due to increased efficiency. But we do downgrade to a neutral rating with a DCF target price of 182 US dollars. But this target price was here raised from $113 from the third quarter, after their third quarter earnings. We reduced our weighted average cost of capital slightly to account for the increase in their debt to equity ratio. and maintain a terminal growth rate of 3.5%. So that's all for me from Meta. I'll hand it over to Max for Apple. Thank you.
Thanks, Jonathan. So we also published our reports on Apple's first quarter 2023 results. And the report is titled Hurt by Supply Constraints and FX. Next slide, please. So revenue and PATMI were a modest miss of at 28% and 29% of our FY23 forecast. And we said it's a modest miss because typically the first quarter makes up like 30% of Apple's full year revenue. So revenue came in at $117 billion, which signifies a decline of 5.5% year on year, and PATMI came in at $30 billion. So for the first positives, Apple's services segment continues to grow despite facing an increasing FX headwinds. The segment grew 6.4% year on year, even though it is facing a 7% foreign exchange headwinds. And the growth also took place despite facing a tough comparison against the first quarter of 2022, where it grew 24% year on year. Apple disclosed that in total, it has around 935 million paid subscription, and this amount is actually 4 times the amount that it had from 5 years ago. And furthermore, it also added that it added more than 150 million of them in the last 12 months alone. The continued growth in services segment was also helped by the continued growth in installed base, which reached the 2 billion units mark. And the growth in installed base was mainly driven by the double-digit growth in emerging countries such as India and Brazil. So, and then for the second positive, Apple experienced a sequential gross margin expansion. So product gross margin was up by 240 basis points or 2.4% quarter on quarter to 37%. And services gross margin was up by 30 basis points to 70.8%. And this is again taking place even though it increased a foreign FX headwinds that is stronger than the quarter before. So, and then the gross margin expansion was also attributed to better operating leverage as well as favorable product mix. So overall gross margin expanded by 70 basis points sequentially to 43% compared to 43%. However, for the negative, Apple experienced a hardware sales decline. So hardware product revenue was down by 7.7% year on year, mainly dragged by the decline in iPhone sales of 8% because the iPhone 14 Pro and Pro Max faced supply constraints towards the end of last year. And then Mac sales was also down by 29%, mainly because of a tough comparison from a year ago period where the product benefited from the launch of the new M1 MacBook Pro. However, the decline in these sales were partially offset by the growth of 30% iPad sales during the last quarter, because it benefited from the favorable comparison because last year the iPad faced supply constraints, and the iPad also benefited from the launch of new products this quarter. During the call, management also said that Mac and wearables were the product categories that were affected by the soft macroeconomic environment the most, while on the flip side, iPhone was the least impacted. So in terms of the outlook, Apple guided for the second quarter 2023 gross margin to be between 43.5 and 44.5%, and this is up from the 43% that it experienced in the first quarter. The strong gross margin guidance was mainly due to the company seeing a weakening US dollars, as well as it is also facing favorable pricing for the components used in its products. In terms of revenue guidance, Apple did not really provide a solid number in terms of the revenue, but it is guiding that the yearly performance for the second quarter is likely going to be similar for the first quarter, which is the decline of 5%. And this is because Mac and iPad sales are expected to decline double digits year on year because both product categories are facing a difficult comparison. For the services, however, it is expected to continue to grow, but will continue to be challenged in digital advertising and mobile gaming as a result of the macroeconomic environment. And towards the end of the call, Apple also indicated that it saw a marked change in store traffic in China following the ease of the COVID restrictions in December. And furthermore, it also sounded its bullishness on India because on top of diversifying some of its supply chains into the country, it is also opening some physical retail stores, as well as working on financing options to make the products more affordable for the local consumers. So in terms of valuation, we cut our FY23 revenue and PATMI by 5% and 1% respectively, and this is to account for the expected decline in hardware sales. We maintain our buy rating on Apple with a reduced target price of $186, down from the previous 190, using DCF valuation with a WACC of 6.4% and terminal growth rate of 2%. We maintain our buy rating because firstly, we think the iPhone sales is going to recover because the supply chain issues have been resolved and that the supply chain are normalizing. So Apple could potentially recapture the sales that they may have lost during the holiday season in the next quarter. Secondly, it's also because the continued growth in services is going to provide. We feel that the continued growth in services is going to provide potential upside because Apple is able to continually add more subscribers onto the business, as evidenced by the 150 million additions in 2022. And services business is a high margin business, and it also provides recurring revenue moving forward. So that's all for Apple. Now I'd like to move on to Comba. And this is a Phillip on the ground. We actually hosted them for a guest webinar last week. So just as a disclaimer, this content is not rated. So for Comba is a Hong Kong-based company, which is a wireless solution provider, and it has its own R&D and manufacturing facility in Guangzhou, China. The company produces in-house almost all of its products and has applied for more than 5,000 patents around the world. Comba has customers from all over the world in more than 100 countries in various regions, but China remains its key markets as around 50% of its revenue come from the country alone. And Comba is actually consistently ranked as #1 or #2 top suppliers for major Chinese telcos centralized procurement, and it has maintained this status for the last 18 months since the mid-2021. In terms of products, Comba has 3 main segments, namely base station antennas, which makes up the bulk of its revenue. Base station antennas is essentially the network hardware that is placed outdoors. And network system solutions, which is the network hardware as well, but it is for indoors, and services, which includes like network optimization as well as regular maintenance. For market opportunity, Comba is hoping to help onto the continued rollout of 5G network around the world, and in particular in the emerging countries like India, and in emerging markets regions like South America, Southeast Asia, and Middle East, because those countries and regions are preparing for the 5G rollout, and they see this as a potential new wave of demand. And for the overall growth strategy, Comba is also eyeing at 5G plus industry, which in other words is saying that the industry practices that can incorporate 5G into the operations. And one of the examples that they gave was smart mining. And it also believes that the indoor products will going to grow, particularly in China, because most 5G network users are going to spend their time indoors. So yeah, that's all for me for today. I'll hand over my time to Glenn for SG Banking Marketing. Thank you.
Thanks, Max. So for the banking monthly, we'll first go to the interest rates. Okay, so for the interest rates, it started to flatten in January, and the 3-month SORA was down 3 basis points month-on-month to 3.05%, while the 3-month SIBOR was up only 1 basis point month-on-month to 4.25%. And the SORA month-on-month decrease was the first since August 2021 and came after 8 months of double-digit month-on-month growth, while the SIBOR month-on-month increase was 22 basis points lower than the previous month's increase of 23 basis points. Nonetheless, the January 3-month SORA improved by 285 basis points year-on-year, and January's 3-month SIBOR improved by 381 basis points year-on-year. So for the interest rates, we should expect the interest rates growth to slow down for 2023 and to remain rather flattish, but it will stay at the current high and elevated levels. Next slide, please. So now for the
loans growth, the overall loans growth fell by 0.3% year-on-year in December to 814 billion. And this was below our estimate of a mid-single-digit growth for 2022, as the rise in interest rates started to be more fully felt by the consumers. However, the fourth quarter 22 loans grew by 0.8% year-on-year, as the growth in October and November pulled up the slight decline in December. The business loans fell by 0.82% year-on-year in December, as the business loans did by 1.49% for the month. The loans to the building and construction segment, which is the single largest business segment, grew by 0.74% year-on-year, while loans to the manufacturing segment fell by 1.01% year-on-year. The consumer loans were up 0.56% year-on-year in December, and this was aided by strong loan demand in the housing segment, which makes up more than 70% of consumer lending and grew by 3.6% year-on-year in December. For the total deposits and balances, it grew by 7.32% year-on-year in December to 1,716 billion. Nonetheless, the current account and savings account, or CASA proportion, it continued to dip, and it dipped slightly to 20.4%. This was slightly lower than October's 20.7% of total deposits, as there was a continued move towards the fixed deposits due to the high interest rate environment. For Hong Kong's loans growth, it declined 2.99% year-on-year and 0.82% month-on-month in December. Now moving on to the next slide. For the SGX monthly statistics, the preliminary SDAV, or Securities Daily Average Volume, for January fell 4% year-on-year to 1,146 million, as the market sentiment remained subdued in the start of 2023 due to macroeconomic factors. And the VIX averaged 20.2 in January, and this is down from 21.8 in the previous month, as the DDAV, or the Derivatives Daily Average Volume, rose 8% year-on-year to 0.92 million in December, but it was down 15.6% month-on-month from 1.09 million in November. The top 5 equity index futures turnover saw a dip of 13.2% year-on-year in January to 13.02 million contracts, and this was mainly due to the lower trading volumes of its FTSE China A50 index futures and FTSE Taiwan index futures. Notably, the Nifty 50 index futures grew 10.8% month-on-month to 2.37 million. Now, the banks, the three local banks, will also be releasing their fourth quarter 2022 results this month, with DBS on 13th Feb, UOB on 23rd Feb, and OCBC on 24th Feb. So for DBS, we have forecasted revenue of 4.49 billion for the fourth quarter and PATMI of 2.02 billion. For UOB, we have forecasted revenue of 3.32 billion and PATMI of 1.59 billion. And lastly, for OCBC, we have forecasted revenue of 3.34 billion for the quarter and PATMI of 2.03 billion. Now moving on to the next slide. We maintain overweight on the banking sector and remain positive on the banks. The bank dividend yields are attractive, with upside surprises due to excess capital ratios, as well as a push towards higher ROEs. And the stable economic conditions and rising interest rates remain tailwinds for the banking sector. SGX is also another beneficiary of the higher interest rates, and we expect a recovery in treasury income due to the high interest rate environment. So that's all I have for the banking monthly. I'll now hand it over to Darren.
Thanks, Glenn. So Fraser Centerpoint Trust announced their first quarter business updates, and together with the business updates, they also announced the acquisition of Next. So the title of this update, I titled it the next acquisition, which is the next acquisition of Next. So for the positives for this business update, the retail portfolio occupancy improved 0.9% quarter-on-quarter to 98.4%, aided by Century Square, Changi City Point, White Sands, and Hougang Mall. And all these leases were signed at a positive rental reversions for the quarter. So right now, 8 out of 9 of their malls, their occupancy is above 97.8%. The only one that's lagging is Century Square, and the reason is because last year Century Square, their anchor tenant, the cinema Film Guard, they left the space. So right now they are in advanced talks to backfill that space. So we are hoping to hear some good news going forward. And for the tenant sales and shopper traffic, they grew 13.4% and 4.3% year-on-year, and it's averaging 116% and 82% of pre-pandemic levels for the quarter. As you can see on the left-hand side of the two charts, the top left-hand side is the portfolio traffic, retail portfolio shopper traffic, and the bottom left-hand side is the portfolio tenant sales. So this is since COVID. As you can see, the blue line last year, the shopper traffic is improving from 61% to 80% towards the end of the year, and the tenant sales maintain above 100% for the full year over the course. This is compared to pre-pandemic 2019 levels. So going forward, we expect the tenant sales growth to actually moderate and not show so much growth as year-on-year before, because of mainly the GST hikes. We think, and because of a possible slowdown in consumer spending. So these two factors could probably affect the tenant sales going forward. And for the negatives for FCT's business updates, they have a high cost of debt. Their cost of debt for the first quarter increased 50 basis points to 3.5% from 3%. And right now, FCT's 73% of their debt is hedged to fixed rate, and this is on the lower end compared to a lot of their peers, which are around 80% to upwards of 80%. And another factor that is affecting them is because is that 46% of their debt matures in the next 2 years, FY23 and FY24. And when they refinance it, it's likely to be at above the 4% levels. So that will again increase their cost of debt going forward for the full year. We expect their cost of debt to maybe be around the higher ends of 3 for the full year going forward. Moving on to the next slide. So regarding the acquisition, FCT and its sponsor Frasers Properties, they announced a joint acquisition of a 50% stake in Next. So post-acquisition, FCT will own 25.5% interest, while FPL will hold a 24.5% interest. The estimated purchase consideration is 340 million based on the adjusted NAV of the trust of 1.305 billion, and this valuation is in line with Next's latest valuation of 2.07 billion. And FCT intends to fund this by taking on a 3-year debt with an estimated all-in interest cost of 4.3%. So the pro forma DPU is estimated to be, the deal is actually 0.52% DPU accretive on a pro forma basis, assuming it's fully debt funded. And the post-acquisition gearing will rise from 33% to 38.5% pro forma. But actually the deal, there are a lot of uncertainties regarding how accretive this deal actually is, because like we can't see the debt, that the interest at a vehicle level, like how much that is being paid there, and then as well as some other costs like utilities, all these. So there's a lot of black box that we can't really see. But however, we think that this Next is a good strategic fit for FCT's portfolio, as it is one of the largest suburban retail malls in Singapore, and FCT's their portfolio is full of suburban retail malls, and it also has a committed occupancy of almost 100%, and its remaining lease period is 95 years. So they also announced during the first quarter business updates that they'll be doing an AEI of 38 million for Tampines 1, where they'll they'll transfer some of the NLA from some of the not so prime areas to like the level 1, level 2, and the B1, the prime areas. And also through the GFA program, they're also unlocking some additional space. And the management estimates that this AEI will come in at an ROI of 8%. However, for FCT, even though their operating metrics continues to improve, their short-term maturity and their low hedge ratio will offset some of the gains going forward. So they'll be more affected by the rising interest rates, like higher rates than their peers because of the factors I mentioned in the previous slide. And so with that, we maintain our accumulate on FCT, and we lower our target price from 2.3 to 2.31. Our DPU estimates are trimmed by 6 to 8% after we factor in the Next acquisition and the higher borrowing costs. The current share price implies a DPU of 5.5%. So that's all for me. I'll hand over the time to Terence.
Yeah, thanks, Darren, and good morning, everyone. Sembcorp Marine has announced the EGM, which will be held on the 16th of Feb 2023. So for those who have been following Keppel for a while, the EGM is finally here. The Sembcorp Marine shareholders will vote at the EGM on the 16th of Feb to vote on its proposed acquisition of KOM. Some of the key highlights of the circular: the newly merged entity will have a new board and management team. The current CEO of KOM, Chris Ong, will replace Wong Wing Sun as the CEO of the new merged entity. Mr. Wong will remain as senior advisor to the new board for an unspecified period to facilitate a smooth transition for the new team. The IFA has also looked at the deal and are of the view that the terms of the proposed combination are fair and reasonable. It has recommended Sembcorp Marine shareholders to vote in favor of the proposed combination. So in terms of the timeline, should the proposed transaction be approved by Sembcorp Marine shareholders, then a completion of the entire transaction is expected on or prior to the 20th of February. So in terms of the positives, we think that the better clarity on the deal timeline and also the future management should reduce the overhang on the stock. If you look at this, the new management team and the board that is coming in, it does look like a reverse takeover, and the team from Keppel O&M is coming in to lead the new merged entity, which is good for the group. The newly enlarged group will also be able to better capitalize on the energy transition by bidding for more new energy contracts for the group. In our next slide, in terms of the outlook, the divestment of KOM will further transition the group towards an asset-like structure. The Keppel shareholders are also expected to receive the dividend in specie of the new group, but this is of course contingent on Sembcorp Marine shareholders approving the deal on the 16th of Feb. So in terms of our recommendations, still no change. We maintain a buy with an unchanged sum of the parts target price of $8.95. This is still at a 20% holdco discount. We also note that this holdco discount should actually reduce over time as the Keppel starts to shed its conglomerate status, starting with this deal, as Keppel moves towards transforming its business to being asset-like. So that's all from me for Keppel Corp. I'll now hand over the time to Zain.
Thanks, Terence. Good morning, everyone. Now I'll be going through the technical analysis section. Looking at the Straits Times Index, we could be seeing a continuation of the consolidation that took place last week after the breakout of the key level at 3,330. So currently it looks like we are facing some resistance at from 3,390 to about 3,470 area, which is the highest from the May of last year, as well as in February of last year as well. For the immediate support wise, if you do a pullback, we could see around 3,300 to about 3,360 area, which would be a retest of the previous inverse head and shoulders breakout, as well as a retest of the trend channel resistance as well. The trend channels will be the two trend channels labeled in red and green in the chart shown. So that's for the Straits Times Index. In my next slide, I'll be talking about S&P 500. So for now, the bullish momentum is still evident as we broke above the 4,100 double top resistance that was formed in December of last year. We also saw a golden cross, which was formed after the trading session on Thursday. So we saw the 50-day moving average cross over the 200-day moving average. And this was last seen in July 2020. So that's another bullish signal as well. For the immediate resistance wise, I think the first level to look at would be at 4,180, which was the swing high towards in late August of last year, and toward to about 4,330 area, which is the swing high created in mid of August of last year. So the resistance zone is labeled in red. For the immediate support wise, we could see around 4,020 to about 4,120 area, which is the area that we actually broke out of. There's also a trendline support shown in the chart also. So if we do a slight pullback, we could find support at this trendline as well. So overall, it looks like the S&P could still continue its bullish momentum if these supports hold. So that's all for me for the technical analysis section. Now I'll pass on my time to Sean to talk about the FOMC meeting highlights that took place last week.
Yep, thanks, Zain. I'll be going through the meeting highlights that happened on the 1st of February last Wednesday. So for those who have missed out on the FOMC meeting last week, the Federal Reserve has raised the federal fund rate yet again by a modest 25 basis point this time around, bringing the current rate to a range of 4.5 to 4.75 in this February's meeting. There is no dot plot graph being provided as it is published every quarterly, so the next one will be in the March meeting. So despite slow growth in consumer spending, inflation still remains well above the rate of 2% as total PCE prices rose by 5% year on year over the 12 months ending in December. And excluding the volatility of food and energy categories, core PCE prices rose by 4.4% year on year and 0.3% month on month in December as well. The inflationary data received over the past 3 months shows a welcome reduction in the monthly pace of increases, but the committee have said that more substantial evidence will be required. So in terms of guidance, Chairman Powell has specifically mentioned that there will be a couple more hikes to come, but didn't specifically mention on how many more times that will be. However, we believe that there will be probably around 2 more 25 basis point hikes, one in the March and the other one in the May, before the rates reaches its peak. However, for more clarity on this matter, there will be a release of the next dot plot projection, which is in March. So some of the notable mentions by Chairman Powell in this meeting was that it is the first time that he has mentioned to the press that he was pleased to see the disinflationary process playing out, but it is still too early to be complacent. So despite the market starting to price in that there will be a rate cut near the end of the year in the Fed funds future curve, we believe that it is unlikely that a pivot will happen anytime soon, unless upcoming inflationary data are portraying that inflations are indeed trending towards the Fed targeted goal of 2%. So that's all I have for the FOMC meeting. And with that, I'd like to hand over the time to Paul to talk about SG Weekly.
Yeah, thanks. Thanks, Sean. So next slide. So for some of the key macro highlights for Singapore that was released last week, we had the PMI for Singapore. It was relatively stable, so that's a good sign. Retail sales in Singapore remains very robust. So you can see that December retail sales was up almost 10%. We exclude motor vehicles because it's volatile. I'm not sure how much of it was driven by GST spending, but it remains very strong. Pre-pandemic retail sales in Singapore was roughly around 1% a year. So this is like 9 times higher. Of course, you got inflation and so forth. The other thing was supermarket sales was down 2%. And for the fourth quarter, because we normally try to look at the fourth quarter numbers because to compare with Sheng Siong's results. So Sheng Siong results should be weaker, but of course they do take market share, so they should they typically outperform this 4.7% decline in the fourth quarter. We had also had the US payrolls, which is the number of jobs that have the new hires. Trying to put it in more layman perspective, but so in January the US had 517 compared to, I think expectations was probably 180 plus. So this is a huge number. If you pre-pandemic, the US was generating maybe 160,000. So this is like triple the levels that they were experiencing compared to 2019. And if one sector alone, leisure and hospitality, of course, it's more like hotels and so forth, we took out almost 128. So this one segment alone was almost equivalent to the number of hires they had pre-pandemic. So services, the other strong segment was education and health. But again, in the US, this is always expanding because of the need for healthcare workers. In terms of the PMI, so manufacturing is down, continues to drop, and then services is up. So what we see in the US right now is a bit of a two-tier market. Services is very strong. Like we mentioned, most of the new jobs that you're securing is on the services side. But what is weak is manufacturing. So it's also confirmed by the PMI, where you see the thing continues to slide from 42. Usually people view 50 as expansion. So this is one of the worst since the pandemic, 42.3 reading. In terms of a tactical view, we expect near-term weakness in the market. Because I think the expectations now is that the Fed will going to tighten more than expected. And we also worry that there's a bit too much speculative fervor in the market. I think one way to gauge is if you look at the meme ETF, it's up 35%. So one way to, I guess one way to kind of interpret this is that, something similar when you see any stock start to surge up, then probably it's like the last leg of the rally or maybe a peak in the rally. So this is something that we worry about in the near term. Because all the meme stocks were up like 30% in just 1 month. The other point that we mentioned, what we see in the US, that's why a soft landing is still possible and a deep recession is at least unlikely because services is really pulling up the US economy, as we've seen from the jobs data. One of the now that we are back into the interest rate theme or rising interest rate theme, I think one of the beneficiaries is also SGX. So though SGX makes about around roughly 400 million in, I think, net profit. So what they do is they generate a lot of treasury income, which is another word for interest income, from the 14 billion collateral balance they get from all the clearing members. So this is almost like a bank deposit, but they will share some of this interest income with the clearing members. So you can just imagine if you take 1 percentage point of 14 billion, you're talking about 140 million. So what is happening is that in the FY22 they made like 50 million in treasury income or interest income, but in FY20 this was almost triple, 135, and this was even before the recent spike in interest rate to record levels. So we think, at least on paper, in SGX, there's an opportunity for interest income or treasury income to triple from this 50 million, which is huge because SGX makes about 400 plus million a year roughly. In terms of the key events, on 7th of February, there will be an interview with Powell, which is also makes us a bit cautious, because in the FOMC meeting, he was seen to have made like a silent pivot because he didn't comment much on financial conditions. I.e., what he means that he isn't worried that the market expects interest rates to peak or come down. So we just worry that he might become more hawkish, and that might kind of unshackle the market a bit more. Some of the results coming out, we have on the 8th of Feb is Prime, and then on the 9th of Feb SGX. Some of the webinars we're having, we have a lot of webinars. I think for this week, we have Prime and Manulife, but Manulife is only for the TRs because they requested that. So it's not open to everyone. But the rest of the events are all open to everyone. You just have to register in our website. The link is there. Just go to Poems. In terms of the domestic economy, just to give you some flavor, so we had the 2022 construction. So for 2022, sorry, you may not be able to see because the font is small, but 2022, the construction contracts awarded was almost like 29.8 billion. And the BCA guided, they normally give a range, so we just take the midpoint, so it's almost 29.5. But I guess the one thing to note from this chart here is that construction for the next, at least the next 5 years would be quite stable. And usually the BCA forecast is actually quite, it's quite sharp. I mean, it's very accurate. Of course, they have a range. Whereas if you compare to the last few years, 2006 to 2019, you can see the construction contracts can be like, it's feast and famine, it can swim up and down. So we think that this is a positive outlook for the construction sector. But having said that, I think in the near term, they are going to be affected by the like what Terence mentioned earlier before, the heightened alert. Basically, what it means is that a lot of construction activity has kind of stopped because of all the regretful kind of workplace fatalities. So a lot of construction sites now continues to get like on-site inspection. So all this actually disrupts a lot of the construction activity. So this is going to affect, at least near term, some of the building material companies. On the right is just to show you the retail sales. The line to focus is the blue line, and you can see that it's so much higher than pre-pandemic, which was probably sometimes negative, sometimes around 1 to 1% kind of growth if you kind of average it out. Next slide. The next is just wanted to highlight the US just to give everyone some understanding. I mean, this is not an economics webinar, but the good thing why we say Goldilocks is that although employment is very strong in the US, but strangely, I'm not sure how it works, but you can see that the wage growth continues to slide. So this is very positive in terms of the fears for inflation, especially inflation expectations. The table on the right is just to show you how strong the employment data is in the US. So 2019, you can see in the red bar, they used to average a month is 163. Right now, it's in January is 500,000, so it's 3 times faster. And hospitality used to hire maybe 30,000 a month. Now it's, I don't know, 128, so it's 4 times faster. So it just shows that now the Fed has probably a overheated labor market. And for Powell, I think a few months ago, what he mentioned in terms of what he wants is probably 100,000 new jobs a month. But right now we're running at 500,000. So I'm not sure what he's going to say in the interview. Next slide. So this is our usually every month end we just give some we just give how our model portfolio has performed. Again, this is just for illustration. You may or may not be able to replicate, because the mechanics of it is that we just put 10% to each stock, and then every month we just rebalance to 10. I mean, it's just for ease on comparison. So there could be brokerage and so forth, but beat us, and then of course we don't take into account the dividends that is collected, if there's any. So again, just for illustration, so for what did well was the REITs. So some of the REITs and the banks did well, like DBS, OC. What pulled down was Del Monte and Comfort. Hopefully nobody asked me that. But anyway, Comfort was down, and then the main one that dragged up was REITs. The table on the right is just how. So for the STI was up about 3.5, and this so-called model is up 4.8. Next slide. So this slide is just for everyone's just for record. I mean, just for your illustration, for your, if you want to track. So we also track like what sectors did well. This is our own classification. So REITs did well in January. So the interest rate sensitive stocks outperform. You can see hospitality and so forth in the box there. What didn't do well was telecom and shipping. I guess the defensives. The top 10 gainers is, again, this is just from the 124 stocks. It's not the whole market, but because we try to take those that are more widely the larger companies. So what did well was a lot of the REITs are in Prime, Pacific Oat, Keppel DC. The top 10 losers in the market is, I think all these are quite company specific. The other have profit warning or liquidity or demand or letter of demand. So like Tasin had a letter of demand. Metex had profit warning. IFAS also, I wouldn't say profit warning, but they just said that some of the projects were stopped. Then in terms of the gainers, we have these are below is all the STI or the SPDR kind of ETF gainers. So you notice also again it's all the REITs, and on the bottom right is who are the losers. So Yang Zhejiang Shipbuilding. Out of the 30, only three were in negative. So the market was actually quite vibrant. And next slide. So this is my second last slide. So this is just to, again, we also just trying to track January, just for your reference. What assets did well? This is in US dollar terms. So of course, the REITs did very well. I think it's even outperformed S&P 500 in US dollar terms. And the best performer was of course Nasdaq, was up almost 11. And the worst performer was commodities. Bonds also did well, up 5%. Again, this is just for your illustration, just to get a sense of. So it was everything rallied kind of January. Yeah. Next slide. This is my final slide. So this is just our earnings calendar. This is not the exhaustive list. I mean, not every stock, but this is some of the bigger ones. So in yellow will be those stocks that we cover, and we should have a note out. Excuse me, once the results is out. Again, this is just for your reference if you wish to have look. Okay, next, I think, yeah, that's it for us. I think we can go to Q&A.
Yeah, I think I'll take some of the Q&As first for the US side. Okay, so there's a question here. What do you mean for Spotify accumulate downgraded? So basically, downgraded means we downgraded from our previous call. I believe it was a buy call. Accumulate is how it is neutral, accumulate and then buy. So accumulate is still a buy. It's just not a strong buy. So downgraded is because we downgraded the rating from our previous call. There's another question here. The big cap tech stocks like Apple, Amazon, Microsoft have rallied strongly recently. Do you have any views if their rally will continue breaking the downtrend, or if it might be a bear rally again? Yeah, so it's actually quite interesting. None of these companies actually issued good earnings, like exceptional earnings. For the most part, actually, they had relatively weak earnings. But I think it was mainly, at least for a lot of the big tech companies, my guess why they rallied is because a lot of them mentioned that they would focus a lot more on efficiency. So just by virtue of that, investors probably expected margins to expand. And that's probably why it ran, because earnings. So probably the earnings estimates were revised up. Yeah, otherwise for the fourth quarter, I mean, no one really did very well. We do think that the rally probably isn't very sustainable. So I believe as it closed on Friday, when S&P was up 17%, and most of these stocks were up way more. So yeah, but we think just that there still are a lot of uncertainties. There's still a lot of earnings overhang, at least in the near term. So do you think that there might be some ceiling to this rally in the near term? There's another one about the shooting of a China balloon over US airspace. How will this affect the US-China relationship? We don't really want to comment on China, but I mean, the relationship is not great anymore. So we don't think this changes that much with respect to both. Here, could you comment on the reasons Apple, Alphabet, and Amazon? Yeah, I believe I already mentioned this earlier just now. Earnings were not great, but even the outlook, most of the outlook for these companies weren't even that good. It was more internally they're cutting costs, they're leaning out. What else? I think that's all for on the US side. There's this question about Adani. I think for here it is. As retail investors, what lessons can we learn from Adani fallout? So just a short summary. The Adani fallout came, I guess, towards the end of January. There was a short seller called Hindenburg Research to put out a report saying most of Adani's financial results were fraud. They were parking a lot of money in shell companies and moving it in and out to make it appear that sales was better than expected. And also a lot of other accusations. I guess what you can learn is maybe do a little bit more due diligence. I'm not really quite sure what else you can learn from that. Stick to companies that you know well, that are a little bit more transparent probably. Yeah. Okay, I think that's all for my side. I'll hand it back to the rest of my colleagues to answer this. Thank you.
Yeah, okay, let me just take some before I hand out to the rest. So anyway, for the Adani, when it comes to fraud, I mean, it's almost impossible for us. I mean, if the reports are already audited, I mean, as an analyst, it's almost impossible for us to go and figure out if there's any fraud since it's already audited, and these auditors have more details than us. But what we can only do is just to see how aggressive the accounting is, or how much leverage the company has. So one, and of course the free float. So one of the pushbacks the report had was the huge amount of leverage. But when you look at the leverage, actually Adani Wilmar wasn't actually looked more favorable than its peers. And also the other pushback was the very thin shareholding, which of course Adani Wilmar also has. They only had only 12% was floated. And there's no fraud. There wasn't any allegations of fraud, at least for Adani Wilmar. It was, I think what they mentioned was just that it was very thin, very shareholding spread only 12%, didn't meet the requirements of 25. But that was already kind of mentioned in the IPO that they will slowly bring it up by 25 by February 2024, I think. Yeah. And let me just answer this two more first. So for Adani Wilmar, the other question was how is it going to impact the worst case scenario for Wilmar? So when I was looking at Wilmar's annual report, Adani Wilmar is a joint venture, so there's only a one-line item, net assets. So their net assets to Adani Wilmar is about 200 million US. Of course, it's a huge amount, but compared to the, I think the total equity for Wilmar is couple of let me double check. The total equity for Wilmar is 22 billion. So worst case, if this is impacted, this could be 10%, I don't know, 1% hit on their equity because they got like 22 billion US of equity. So the impact isn't huge. Of course, the only unknown is whether there's any debt that Wilmar has kind of underwritten. But it would be highly strange that Wilmar want to do it. Since this is a joint venture, not even a subsidiary, why would they kind of underwrite debt for their joint venture partner? So I think that the impact won't be that huge for them. Even the profit from this is probably less than 5% contribution from Adani Wilmar. So I think the worst case scenario, I think the impact was kind of sheltered. Let me just take one more question before I move on. Paul, since you initiated on Asia Pay TV has fallen by 80%, how did you manage to get it so wrong? Okay, firstly, this won't be the first time I get it wrong. Hopefully, we'll definitely get things wrong. But so when we initiated, it was 49 cents. Then plus all the dividends, I think it's probably about 15 cents. So it's still down 40%. So when we initiated, it did go up to 60 cents. But anyway, so what had happened for us, the assumptions we made wrong was, what is it wrong a bit? We were too fixated on the yield. Because they were paying, I think, 13% dividend yield, and at that time, everywhere was negative interest rates. So we were just making an assumption that they can maintain, but they couldn't maintain the dividend because of two reasons. The leverage keep on piling up. And there's probably one thing that was most of the dividends they paid was by taking on the leverage. But the main thing was that why the leverage jumped so much was because when they took on this capex that was imposed by the government, I think additional 300 million, we thought that they could generate extra revenue from this, because what they were going to do is they will put additional they were going to put additional set-top box in every Taiwanese home. I mean, in the areas that they were controlling, because the government asked them to. So we thought that they could at least get some revenue, incremental revenue from that through broadband or higher speed plan or that. But that didn't pan out. So because of that, they were stuck with this additional leverage, and then they had to cut the debt. So this is one of the things. So I guess the one lesson is that companies that have very aggressive leverage, that's something to just be wary about. But again, we will still do such. We will still even leverage. The company might be leveraged. We will still call a buy. Sometimes it's just a way how we assume. Sometimes as an analyst, if we are comfortable with the risk, it's all risk reward, right? I mean, we can always just call a buy and ST engineering, and because it's the safest thing. But we will sometimes go up the risk curve. I think there's no choice. If we feel we are comfortable with it, then of course sometimes we get it right, sometimes get it wrong. But again, you just have to go through a report whether you're comfortable with the risk, or of course just ask us, what are you comfortable with the kind of assumptions that we're making. But again, we will get things wrong because we always make some assumptions, and it doesn't of course pan out right all the time. But thanks for bringing it up. I also didn't recall the data. Terence, you want to take on some first?
Yeah, sure. Let me just take the questions. Keppel Corp, any view on latest Keppel Corp results? Thank you. Yeah, so Ray, what Keppel did differently in these latest results is to actually deconsolidate the discontinued operations from their continued operations. This makes the comparison between the last financial year slightly more difficult, because what they do is they strip out those assets they go to strip out. But in terms of so we are just working on harmonizing the results so it's more comparable for everybody. We should get the results, we believe, by tomorrow or Wednesday. But in terms of a very quick commentary on their latest Keppel Corp results, I think the rest of their results were humming. It was ahead of our expectations. The only one that was unsurprisingly disappointing for them was the property segment because of the China property slowdown. But during the conference call, we actually asked them about their view on the China property market. What they have said, they say is that since the relaxation of China COVID measures late last year, they have seen an improving sentiment in the Chinese property market. So they're actually quite positive on this segment, which is obviously the one that is weighing them down for 2022. So hopefully we get to see better results. Next question, after Keppel divest its O&M business, will the NAV drop? There are a few questions here, so I'll just read them all, then I'll just take some of them also. Will the share price drop? Does your target price still hold? So I think the last part first, will the target price still hold? Yeah, so the target price is contingent on the vote by Sembcorp Marine shareholders, because what we did was we computed the total the divestment kind of gains that they will get, but it's also to realize this value is contingent on them being able to divest this to Sembcorp Marine. I think there are a lot of speculation in terms of like what will happen if Sembcorp Marine vote down the deal. We believe that Keppel will still divest its O&M business, but that will take time. So between now and when they can realize the entire value, there's a lot of uncertainty, and it's a risk event as well. So the target price is consequently our target price currently consequently also reflects the kind of risk that we see in terms of the deal not going through. But assuming the deal goes through, the NAV will drop. I think in our model, let me just pull up the model here so that we can take a look. The NAV will drop from to $5.51 post the transaction. And so why they kind of drop is because they're going to distribute 19.1 Sembcorp Marine share for every Keppel share that you own. So in essence, what that means is you're getting about $2 back per share. In fact, I think in their official documents, they use $2.33. Sorry, I know it's a lot of numbers. So if it's very confusing, just let me know in the comment section also. But essentially, if you look at their circular, they use $2.33. It means that Keppel shareholders, in essence, when you get back the 19.1 per share of Sam Marine shares, you're actually getting back $2.33, which means if you look at your question, will the share price drop? Yes, it should drop by $2.33. But one of the things that we want to note here also is this $2.33 that they computed is based on 12.2 cents for Sam Marine shares. And if you all have been following Sam Marine's share price, you'll know that it's already gone to about 14 cents. So if we use 14 cents instead, that will actually be $2.69 per share, not $2.33. So if we just do a very quick and easy way, just back of the envelope kind of calculation, what you should do is you look at the current Keppel share price, then you minus $2.69, or you can do a discount from there. Then you get the current the X dividend price that you should get. That's the X dividend price, which is quite close to its NTA. Is about $5.50. So if we assume that you do that, then you can see that it should be trading about $7.60 now. So what about our target price then, in terms of our target price for Keppel Corp? In total, what our model is suggesting now is, if we look at the asset co transaction, and also just a reminder, the asset co transaction and the KOM divestment, both of these will yield $9.7 billion for Keppel. It's a very big number, I understand. But what it means is that per share, the divestment of these two, asset co and KOM, will accrue to Keppel $5.52 per share. And that's only the O&M business. So if we look at the rest of the business, the NTA of the rest of the business, $5.23, then when you just compute like that, the target price should be about $10, right? Yeah, so I understand that it's very, very complicated. So sorry that but there's probably a better way to explain this, but we'll try to do that in our report, which we'll try to publish by this week. If I was confusing, please let me know in the comment section. Yeah, thank you. Let's go to the next question. Best stock to buy, Keppel or Sam Marine? So in our view, we have no coverage on Sam Marine, but we believe Keppel is obviously the better buy now, mainly because of they're going to, the top line number is they're going to realize $5.50 in realizable value from their O&M business. So the whole entire O&M business goal is $5.50 already. So if you look at the share price today, it's just $7.20, which means that what the market is valuing the rest of the business is $2.20, which is clearly not the case because the rest of the business is already $5 over. So we are talking about $3 gap now to what the if we just value it by 1 times book. Hi Terence, what would be your anticipated target price of Keppel Corp post distribution of dividend in species of Sam Marine? Yeah, so this is a very similar question to the previous one. Yeah, the anticipated target price should be about 10. How we get about $10 is $5 in realizable value from the O&M transaction, another $5 in NTA, just assuming that we value the rest of his business, which is their infrastructure business, their connectivity business, their asset management business at 1 times book, which is what the market has traditionally valued them at. Then it should be about $10. But having said that, I'm also very careful to say that a lot of this is still contingent on the deal between Sam Marine, how Sam Marine shareholders vote. Any thoughts on the merged Sembcorp Marine and large entities NAV? Yeah, so for Sembcorp Marine, in the near term, our own view is that there'll be a slight overhang because there'll be a lot of shares released to acquire KOM. But the new management team and I think the new board is actually the key thing to watch because they have ambitious plans to turn the new entity around. Hi Terence, when would Bifrost cable contract contribute to Keppel Corp underlying revenue and earnings? So we expect this to be about 2024, 2025. There's some background for the Bifrost cables. They initially built four cables, but because of the strong demand for these Bifrost cables, they actually went to build 8 cables. And even when they built 8 of these Bifrost cables, the demand was so overwhelming that all of the 8 was rented out. So what they do is they go and build another 4 more, 12, and these 4 they don't lease it out. They keep it for themselves. So they believe that they can get a better rate by holding on to these Bifrost cables. So yeah, it's actually one of the areas that they are actually very, very excited about in terms of the contribution because there's very strong demand for that. What is the outlook for Singtel and SATS? Yeah, I think leave Paul to take the Singtel question. So since our publication on SATS, the China has actually relaxed border restrictions, and so that has actually had a very positive knock-on effect on SATS. The outlook for SATS is bright now that the China tourists can actually come back already. Yeah, so positive outlook, but we haven't updated yet. Let's keep the question here. So let me just scroll and see if there's any other questions before. What's the outlook for Keppel and Sam Marine if the Sembcorp Marine shareholders did not approve the merger? So Linda, the first thing first, the Keppel is already going to realize about $2.50 from the divestment of its asset co. That transaction is going to happen independently of the transaction with Sembcorp Marine. So regardless of how Sam Marine shareholders vote, Keppel will divest. I think management is also premature to discuss what happens to KOM, assuming the deal don't go through. What we can take guidance from is Keppel has long stated that their intention is to transition towards an asset-like structure by 2030. So even in the scenario where the divestment of KOM doesn't go to Sam Marine, then we believe Keppel will still find another way to divest the KOM business, because their long-term plans already don't have, they don't envision Keppel O&M in their long-term plans as part of being asset-light. In terms of outlook for Sam Marine will be a little bit more bleak. Again, we don't cover Sam Marine, but we just offer our view, but we just share some of our views, because you can see in this new management shake-up, the board is already stepping down. The CEO for Sam Marine is also stepping down. So if assuming the Sembcorp Marine shareholders don't approve the deal, then there's almost the outlook seems a little bit bleak, because the way forward for Sam Marine, we believe, will be very uncertain, especially because a lot of the almost the entire board, except say for one person from one director from Sembcorp Marine will be staying, but the rest of the board will be stepping down. Even the CEO for Sam Marine is also stepping down. So we think if Sam Marine shareholders don't approve of the deal, then the outlook for Sam Marine will be really uncertain. Yeah, let me just see. Another question. Could you comment on the outlook of oil-related stocks in Singapore? Example, Sembcorp Marine and the US Chevron. Do you see their stock prices doing well again in 2023? Thank you. Yeah, so I'll probably leave this question, the US side for the US team if they can take it, but I'll take the outlook of oil-related stocks in Singapore. For oil-related stocks in Singapore, they continue to benefit from the higher oil capex. I think Paul mentioned this earlier about how the oil majors have already increased their capex, and so that has had a knock-on effect on companies like Sembcorp Marine and all the oil-related plays in Singapore, because they have seen higher order books and better rates for their businesses as well. But having said that, one of the things that we are mindful of, especially with Sembcorp Marine, at least from our experience from 2022, is that the business can be doing well and that can help your order books, but you also need to have a tight lead on costs. So what happened is that for Sembcorp Marine, last year they were guiding the market in terms of a better second half, but because they overran certain costs and their labor cost was higher than they projected, that weighed on their profitability. So we think the stock prices can do well, but they need to watch their cost structure. Then if they can keep their costs and gain a decent profit, then we believe their share prices will be great. Can elaborate on share overhang for Sam Marine after merger for how long? Yeah, so because of the new supply of shares, that we believe there'll be a slight overhang on Sam Marine after the merger. But having said that, with the new management team, I think they have a very strong plan to grow the business after the merger, and that will also put them in a better state to compete against the China and Korean yards. So the outlook for Sam Marine is positive. And like one of the attendees who mentioned earlier on, the oil price increase in the last few years have been good for Sam Marine. Okay, Terence, your $10 price target for Keppel, is this after conglomerate discount? How much conglo discount do you use in your valuation? So I'll take the second question first. We use 20% conglo discount in line with how the rest of the market typically provide for the conglo discount. The $10 price target for Keppel, this is again based on our, I want to emphasize here, this $10 price target is based on us summing up assuming a 1x NTA for the rest of their business X O&M, and then the realizable value for their O&M. So is this after conglomerate discount? No, so this is not after conglomerate discount. So, but what we can assume is that if you reduce the number of parts within the conglomerate, then correspondingly you expect the conglomerate discount to reduce, right? Because you're no longer holding so many parts. Yeah, but thanks for the follow-up question. It's a good question. I think, yeah, that's all from me. I'll hand back to the rest of my team members.
Yeah, thanks, Terence. I think I'll take some of the questions first. I see I think 2 questions regarding the banks. So the first one, it's for banks, share prices have risen quite a bit. Is the possibility of increased dividend already factored in for all banks? And how about the case of DBS, special dividend due to some Basel IV requirement recalculation? Is it factored? So I think it's slightly too early to say if it's been factored in already, because they will only start phasing in this Basel IV in July of this year. So it will be too early. I think there are other factors at play for the bank share prices rising. I think mainly it's due to their quite strong performance in the third quarter, and they are all the banks are guiding for even stronger performance for the fourth quarter and for the full year. So I think that might be one of the main reasons why the share prices have risen quite a bit for all the three local banks, as well as the high interest rate environment also. So I think with that, I'll move to another question regarding interest rates. Someone asked, why did SORA come down when US is still rising rates? So if you look at the Fed funds rate, actually for January, it was quite flat. And when they rose the rates, it was a lot smaller compared to the previous rate hikes. So the SORA, if you look at the daily chart, I mean, when I put the data out, it was based on the monthly. So it has been also quite flat, but if you look at the last few days of the month, as well as going into February, it has started to go back up again. So now it's hovering around above 3.1%, actually above 3.15% for the start of February. And yeah, I think 3 basis points drop for the month of January is a very slight decrease. It's as good as being flat. So we might see it move up again slightly in the month of February, as just to reflect the increase in the rate, the Fed funds rate hike. So I don't think it really went down. I think it's more of just a very stagnant growth. I think that's all I have. Let me just double check.
Can you take the iFast question?
Oh yes, it's an iFast question. Where is it? Oh yeah, can you explain iFast price surge today? I think it might just be a pullback from the recent dip in the price, as well as I think they'll be releasing their result soon as well. Let me double check when they're releasing the reports. Yeah, they're releasing it next week on the 15th. So I think there might be some positive notes from two of the sectors which they have been hyping on, which is mainly the iFast Global Bank, which is their UK bank, as well as the Hong Kong e-pension. So that might be one of the reasons. Okay, I think I'll hand it over to the rest of my colleagues.
Darren?
Yeah, hi. There are a couple of REIT questions. So the first one is, which segment in REITs do you prefer this year? For me, I think our house view is that we still prefer the hospitality sector because, of course, the reopening of China will help to benefit. It's like a leg up of growth, but then it might not be priced, might come in so fast because there are a lot of inquiries, but actual bookings they are not there as of yet. So you stream in slowly over the year, and we expect the full year contribution of China as well to contribute to the top, as well as like Japan, because last year Japan only contributed like the last 3 months. So the hospitality sector will benefit from that. Industry sector so far, the results actually came in better than I expected. So a lot of them came in at positive rental reversions. So yeah, it came in better than expected, but going forward, there are still quite a bit of industrial space coming to play. Like the last year, the industrial sales industrial land sales, industrial government land sales, yeah, it's at a 3-year high. So there are quite a bit of supply coming in. So going forward, industry might be affected. For office as well, office rentals are at all-time high, but we think you slow down in the second half of the year with the IOI Central Boulevard. That is a lot of, that's about 1 million of square foot of GFA coming in the second half. So that might put a bit of pressure on rents. Yeah, so overall, we still like hospitality sector the best. And we think because of the full year contribution that it will benefit going forward. The next one is what is your latest view on Tassim Retail Trust? So Tassim Retail Trust, they actually defaulted on their loan a couple of weeks back. Yeah, so they're trying to refinance their loan, and there's some difficulties trying to do so. So if it was me, I wouldn't touch any REIT that has difficulty in securing financing or defaulting on their loans, of course, because first of all, the underlying REIT, the business model is to borrow money to invest in property to collect the rental income. But then if you borrow money and you can't even, and you cannot pay out for your loans, then of course there's an issue there. So I recommend you not to invest in that for now, because worst case scenario, if they do default, then there might be some issue with the listing, also might be suspended or something. But that's just a worst case scenario. I touch wood. Yeah, so I wouldn't I wouldn't invest in that. So that's for Tasin. And the next question is, with most REITs doing so well, why would you think Parkway Life REIT and Lendlease are not performing? So for Parkway Life REIT, their valuations are still high in comparison to all the other REITs in the REIT universe in Singapore. But there's not much comparison because there are only two healthcare REITs in Singapore, Parkway Life and First REIT. So there's not much peer comparison for the valuations wise. But Parkway Life REIT, they are trading at I think over 1.5 times book. And Lendlease, their results are out next week, so we might see Lendlease the share price improve if they announce some good results. But the 1 month price, it is actually recovered together with the rest of the REIT market, but maybe not to that big of extent. I think upwards of 5% since the start of the year as compared to the REIT market of 10%. So they are underperforming the general REIT broader index, but they are still up this year. So yeah, I'll be attending the Lendlease meeting. So if you like any input, you can ask me next week about Lendlease. Yeah, I think that's all for me. Let me skim through. Oh yeah, there's one on the Manulife call. I think during the presentation, Paul mentioned that it's a TR exclusive presentation. So what do you expect MUST's coming earning results and its outcome of strategic review? Yeah, so Manulife, they came out with their decrease in valuation, portfolio valuation at the end of last year. So that is probably one of the worst news that can come from their earnings, upcoming earnings. What do you expect? I don't really expect them to that okay, their earnings is later this week. So the strategic review is still ongoing. I'm not sure whether they'll have any outcome of that yet, but they're doing the hotelization and such to increase their rental income that they can collect going forward. So yeah, for that, I also don't really have much to say until their earnings results. So you can ask PhD, or if you are TR, you can join their webinar. Yeah, I think that's all for me. For now, yeah, I think I'll hand over to the rest of my colleagues.
Oh, I think Zain, why don't you go ahead first, because some people have, I think, probably waited quite long for your technicals.
Okay, let me just share my screen now. Okay, it's time to look at some charts. Okay, for first one is Keppel. So Keppel, after the results release, we actually broke below this main downtrend, uptrend channel. Sorry, so I just highlighted in blue. So there's this main blue color uptrend channel that is trading in. Then after the results, we actually broke down over here. So we also currently below another immediate trend line support, which is this black color line over here. So for now, I would think that the next support will be around this $7 and around $7.10 level, which was the swing low in mid of Jan this year. which was also a previous resistance level back in October to November last year over here. But be careful if the sell down actually continues. I think a more extreme level at the low would probably be this red color trend line over here. So if we do retest this trend line, it's also confirmed with a previous resistance level over here around the 680 or 690 level. So that would be a more extreme level of support if this support zone actually fails. Then as for the resistance wise, it will likely be at a breakdown point. So that's around the 740 level to 750 level over here. So that's my view on Keppel Corp. And moving on will be Sam Marine. Jardine CNC first. Okay. For Jardine, looks like we actually kind of broke out of this consolidation range over here. So we actually start in this range between 760 to about 2880 over here for about a month or so. We actually broke above it, but we could be facing there could be some resistance at this 2960 level, which is currently we are doing a sideways trading at because there was a previous support that could act as a current resistance over here. Moving forward, if we do break this resistance, using the Fibonacci levels, the next level we could be looking at is around the $31 level, 38.2% Fibonacci bounce, as well as the $32 around 10 cents level, which is a 50% Fibonacci bounce. So it will be this level over here, as well as these swing highs over here as well, which was a swing highs form in November of last year. So for now, it looks possibly turning a little bit bullish, given that we broke out the range, but we still need more time to tell whether we managed to break above this current resistance at 2960. Okay, the next one is Venture. Venture has been quite a strong performer this year. So we are still continuing nicely in the uptrend. So we actually tag onto this resistance at around 1860 over here, 1860 to 1870, which is the resistance from August to November of 2021. So we could be seeing some pause over here, given that the previous resistance over here. But if we do continue to rally further, I think the next key level to look at would be the swing highs over here, formed in January to April 2021. That's around the $19.10 level over here. There's also another trend line resistance over here to take note if the price actually surge past this horizontal level. For the support level wise, if we do a pullback, the immediate support is around this $18.30 to 40 cents level, which is this swing high we actually broke out of just recently, and we actually saw that buying. There's some lower wicks over here, so that's actually denotes buying for Venture. So overall, still quite a very strong uptrend stock. Yeah. Okay. The next one is some US stocks. So Tesla. So Tesla looks like it's facing some short-term resistance over here at the swing highs of about 198 to 206. So over here, last year we actually saw the two swing highs being formed over in November and in November last year. So this also coincides with uptrend channel resistance in blue over here. So for now, I would expect Tesla to possibly do a short-term pullback, but overall we are still in an uptrend. So the first level of the support will be around 178, 179, this horizontal level over here that we broke out of. The second immediate support will probably be around 167 or around there, which actually coincides with this uptrend channel support, as well as this horizontal level over here as well. So that's my take on Tesla. And AVGO. So that's Broadcom. Broadcom also currently trading in an uptrend channel over here. So still still moving upwards nicely. So currently looks like there's some resistance going on at the 600 level over here for further. The resistance further up will likely be around 620 to 630, which is this uptrend channel resistance over here, and it also meets with this key swing high that was formed in March of last year. So for now, I think the uptrend will still continue. But if you do a short-term pullback, support is likely to come in around the 580 to mark over here, which is the channel support, as well as retest of this swing high over here in June last year. So still moving quite well for Broadcom. Next one will be FV. So FV, I would say the downtrend is quite strong, given that we see consistent selling over here. So for me, I will still wait and see for this stock. So I would think that the next strong support zone will possibly be around 142. So which was this horizontal resistance that we broke out of, and there was a breakout and a retest over here in November of last year. So if you do retest this level, there could be some support coming in for this stock. Then another key level, lower end, will be around 130 to 133, which has been tested multiple times and held up the stock. As for resistance wise, the strong resistance for now will probably be around 150 to 152, which is this area of resistance generated in May to November of last year. So if you do a retest over here in this current downtrend, probably will face some resistance for FV over here. Okay, moving back to some local stocks. Next one will be sets. I think sets are still trending up nicely. Recently, we have been respecting this uptrend trend line over here. Then on last week, we actually retested this 315 swing high in October of last year. Currently doing a pullback. So I think the current support, based on this trend line, is around $3.10. If you drop back a little bit further, I think some support will probably come in around this $3 to about $3 to $3.05 level, which is this swing high that we broke out from in December last year. And there was a retest and a form sort of a consolidation over here before the breakout. So a retest would see some support at this zone over here. Then further resistance upward, if you do break out of the recent swing high, we probably see a retest of 340, which is this the opening price after the gap down in September last year. So this was sets. APEC Realty. Okay, I think this one is at quite a critical juncture. So looking at the longer term chart, there's actually this downtrend resistance line that's acting on it. So we come to touch it these last two trading days with increasing volume. So let's see how it reacts to it. There's also looks like there's also a currently uptrend channel that is currently trading inside it. So there could be some short-term resistance over here based on the downtrend resistance line as well as the channel resistance. The next resistance upwards could possibly be this swing high, which was generating in August last year, around the 68 cents to 69 cents level. We do a pullback over here, then support-wise will likely come in around. The strong support will be around 61.5 cents to about 62 cents over here, which is this horizontal level as well as the channel support over here. So overall, still short-term bullish for now, but overall longer term is in a downtrend for APEC Realty. And moving on to HiBev. HiBev, I think currently looks a little bit bearish, given that we actually start to trade outside of this uptrend channel over here, and currently looks like we are possibly trading a descending triangle formation over here. So it looks like the resistance over here around the 70 cent mark is quite strong. So if you do a pullback, I think the short-term support-wise, you come back to test this 66 cents to 67 cents level over here, which was a swing high in August last year. And we actually saw some consolidation over here in December of last year. So that a retest could actually provide some support at this level. Okay, moving on to the index. Hang Seng Index. Okay, Hang Seng, I noticed two key things. So the first one is there's this downtrend resistance line that actually dates back to February of 2021. So there's a resistance acting on it. We actually broke above it, but we are currently, with today's trading, we're currently come back underneath it. So that's one thing to take note of. So then another thing is that there's this wedge pattern going on for HSI. We actually currently broke down on the wedge today as well. So there's two possible bearish signals for Hang Seng Index for now. So I would say that the first level of support could possibly be around 21K level, which is this swing high over here in July last year. So if this fails, the next stronger level support will probably be located around the 20,000 to about 20.2K level here, which is a stronger resistance in the past in August last year. So that if we do a retest, that will be a stronger support for Hang Seng. So for now, I think let's see whether we can recover back above this downtrend resistance line as well as the wedge support in the coming days. If not, that could be quite bearish for Hang Seng for the near term. And the HSI Tech, okay, I'll be looking at the ETF. So this one, we also broke down this uptrend channel for with the trading of today. So for now, the short-term immediate support will likely be around the 440 level, which is the range consolidation that took place at the start of last month. And it was a previous resistance level back in August last year. So that's the short-term support. Resistance for now probably be around 460 level, which is the point we broke down from. Further support downwards will probably be at the $4 psychological level, which also meets with the range support generated in December of last year. So this for the Hang Seng Tech. Moving back to the local stocks. Wilmar. Okay, Wilmar looks quite just a very long trading range that's forming around $4 to about $4.20. So it's been going on since November of last year. So still less. I think we still need more clues to see where this would head to next. If it does a breakout, there could be some short-term resistance at 425 level over here, and it also meets with this downtrend resistance line that's formed since February 2021. If you do break down, I think short-term support-wise could come in around 394, around here. 30.2% Fibonacci retracement level. And it was a previous swing low support from June to July last year. Further pullback, probably see support at 385, which is a 50% Fibonacci pullback level. So that's my view on Wilmar. Looks like still a lot of consolidation going on. Okay, then Sam Marine. Sam Marine, I think there's some good things and bad things about it. So the good thing is that we actually broke out of this downtrend channel over here. So there was a breakout that took place, I think 2 weeks back. But the bad thing is that this short-term trend line has failed to support it at 14.2 cents. There's also a huge volume accompanied with it on Friday itself. So with that, I think if this 13.9 cents level doesn't hold, right, which is a resistance over here that turned into support, I think we could see further pullback to test this trend line over here. So that's around 13.6 cents over here. So let's see how this shapes up for Sam Marine. Okay, UOL, I think could be still trading in a wedge formation, rising wedge formation over here. We're seeing some resistance coming in at around $7 to about $7.20, this zone over here, which is quite a strong resistance zone from June to September of last year. So it could be seeing some sideways trading or possible pullback that could take place. So the first level of support is around 690, which is this horizontal level in August to September of last year. Then I think a stronger support level will probably be around 680, which is this very stubborn resistance that we broke out of. So as well as the wedge support over here. So we do a retest and find some support, that could be a good entry signal for UOL. Okay, then city development. Okay, city development, quite volatile stock movement. So we actually broke down this $8 mark and then we did a V-shaped recovery over here. So for now, I think we are retesting this resistance zone around 835 onwards to about 860 over here. So that's quite a stubborn resistance that hasn't been broken yet. So for now, the short-term support I think will be this $8 to $8.20 level over here. So, but this is quite volatile because over here you can see support. Then we broke down. We can recover quite quickly. So retest over here, we could see some bounce or continue to move downwards. So, but overall, it's a very range stock. You can see over here. So that's something to take note. If we break down over here at $8, then we could possibly revisit this swing lows at 760 to 770. So this for city developments. Keppel DC, quite strong recently. So following the breakout of this downtrend resistance line over here, then we are currently looks like trading in an uptrend channel over here. Then the good thing is that we also broke out of this horizontal resistance at around $2.05. Currently, I think we are taking a pause as we are at the uptrend channel resistance over here. We're actually above it. So for now, I think maybe some consolidation, or I'm leaning towards a short-term pullback to possibly retest this support at 205, which is also we also saw this swing low being formed over here last week. Yeah. Then but if it continues its run, I think the next key level will probably be around 220 to about 223 over here. So last time this level is a key horizontal support from October to end of 2021. Then we saw it become a resistance from January to April of last year. So this will be a very important zone for Keppel DC to take note. If it continues to rally, that could face some strong resistance over here. Sanders is also another very range stock. So if we look back at the chart, since late 2020 has been a very big range. So over here, we're currently at the resistance at the $3 mark, but let's see whether there's a chance for a possible breakout this time, if we actually follow on from the bullish momentum generated over here, where we have an ascending triangle breakout. So for now, short-term support-wise, I think if we do a shallow pullback, that could be around the 290 level over here. Then if you pull back further, that would probably be at around 280 to 283 over here, which is this horizontal level we broke out of. So I think Sanders worth to keep in your watch list, possible if one day it actually broke out this huge range, then it's worth a trade, I think. Okay, next one is Maple Tree Industrial Trust. So this one also has been strong. So we actually had a report on it. So I called it around here when we had a breakout of this consolidation triangle. There was a bullish sign coming. So for now, the trade is still intact. Short-term resistance wise, we are seeing some resistance at around the 240 level over here. But overall, I think there could be some sideways trade consolidation that might take place before further push upwards. The key resistance I'm looking at is spanning from to around 246, which is this horizontal support last time, to about 255, which is this swing high in September of last year. And these 250s resistance also match with this downtrend channel resistance as well. So that's for Mapletree Industrial. Short-term support will probably likely be this swing low generated at 233 over here. Then a deeper pullback probably see some support maybe at the retest of this horizontal resistance at maybe 230s. So overall, still maintaining the bullish outlook for Mapletree Industrial. Okay, then moving on to the other Mapletree, which is Mapletree Pan Asia Commercial. Also, this one also looking good. So following on from this bullish inverted head and shoulders breakout of the neckline at $1.78, right? I think we're just seeing some form of consolidation possibly. So we might take a rest over here, but I think I'm still leaning towards upwards momentum. So if it does a pullback at 178, which is a retest of this trend line and finds support, that could be a good place to enter. Then the resistance wise, the key resistance will probably lie from I think 188 to about 193. So this resistance zone over here from August to September of last year, there will quite be resistance to take note for this REIT. Okay, then another REIT will be CapitaLand China. So this one, I think for now, it looks like we hit some resistance area at 127, 128. So looking back, there was this horizontal resistance from March to July of 2021. So currently, I will expect some form of pullback that might take place. So if you do actually retest this previous resistance zone from 116 to about 119, and we find some support over here, that could be a good entry again for this REIT, I would think. Given that we actually had a bullish inverted head and shoulders breakout over here. So there could be some retest of it to continue and continuation of the bullish momentum afterwards. Okay, another REIT. So this one is on DigiCore REIT. So this one, I'm also leaning bullish for this REIT. Actually broke out of this downtrend resistance line. We hit a horizontal resistance around the 69 cents level, which was a previous support last year, and currently pulling back again. So I would expect some, this looks like a retest of this downtrend resistance line as well as this horizontal resistance breakout. So I expect some support around the 61.5 cents to about 63 cents previous resistance over here. So we find some support over here. I think that could be a good entry signal for this REIT as well. So that's my view on this DigiCore REIT. Okay, next one is iFast. Okay, let's see why iFast surged today. So looking at the chart, looks like we found some support around this 520 level, which is the horizontal level over here. Then we end up forming an ascending triangle. Today we had a very fierce breakthrough over here. So, but I think there could be some short-term resistance that might be coming in, given that currently we're on a downtrend recently. So some resistance could be at around 563 to 577. So that's a 50 to 61% retracement level for iFast. And then there was a previous over here we saw there was previous support around the 570 to 580 level. So a retest could face some resistance over here. Then short-term support will be this resistance that we broke out from at around the 538 level. So this for iFast. Okay, Fraser, logistics and commercial. Okay, this one also bullish. So as this uptrend channel over here, we're actually trading above it right now. Currently, I think we take onto a short-term, there was a take onto this swing high resistance that was created in September of last year at $1.36 to $1.37. So for now, I think we could be doing some pullback or consolidation. Support wise could be around 129 to 131 level. Then further resistance up could be this swing high at 140 to 141 over here for Fraser LNC. So overall, still maintaining the bullish outlook over here. Yeah. Okay, then moving on to local banks. Okay, DBS. We're still facing resistance at near the $36 level. A good thing is that we are also in uptrend channel. We're still remaining uptrend channel over here. So, and then the good thing is that we're forming higher lows going in. So there could be a possible breakout of this level on one day if it actually happens. But short term wise, we are still looking at some form of consolidation or possibly sideways trading. Yeah. So for now, the short term support could be around the $34.75 to about $35 level over here. So that's for DBS. I think moving on is OCBC. OCBC is retesting this previous swing high at around the $12.90 to $13 level. So still quite bullish as well. We are still trading above this trend line resistance over here. Actually retested it and found some, looks like it's finding some support for now and doing some consolidation. So there's actually a chance for a breakout above to make new highs for OCBC. So I think still quite bullish for OCBC. And I think UOB today, there's also a breakout of this short-term trend line over here. For now, I expect possibly some resistance coming in at $30.40 to about $30.60 level. So this swing high in mid-January and end of January over here. Then moving up would be the strong resistance at $31.30 that wasn't cracked despite testing it multiple times. Support-wise, probably a retest of this trend line over here, close to the $30 level, or this swing low at $29.50 could also be a support for UOB. Okay, I try my best to go through a few more counters, given that we're approaching one. I think I can't finish all, so if I don't cover your counter, you can post it in the Volume 3 community under technical analysis, and I'll answer your question over there. Okay, what's your view on SIA? Okay, SIA, I think currently possibly trading in a rising wedge formation over here. So short-term resistance-wise could be around $6 to $6.06. So this I point out this $6.06 level is because I saw that last time this was quite a strong support last time from 2018 to 2020. So a retest probably be quite a strong resistance going in. Then as for the current support, I think it's at this $5.90 level, which is the wedge support over here. Then we could also see around possibly see around 580s over here, which is this consolidation over here. And then it was a previous previous support that turned resistance that cleared again that was formed in February 2020 before the COVID crash. So this for SIA is still bullish. As long as we maintain in this wedge and try to possibly break out in future. Comfort, sorry, CICT. In CICT, I think we hit some resistance near this 218, which is a bit short of my target here at around 220, but it's quite near there. So currently we are doing a pullback, which is healthy. Retesting, looks like we are retesting this horizontal resistance level at $2.08. So if you find some support here, we could actually see a bounce again to this swing high at 218. If we move lower, then I think we could be possibly respecting this trendline support instead. That could bring us to some support around 204 or 205. So this for CICT. Still bullish if we do the retest and see a bounce afterwards. Okay, then I'll cover ComfortDelGroup Group. In ComfortDelGroup Group, I think still we see some resistance taking place at $1.21, which is the previous support over here. So a retest ended up being resistance. So I think resistance will still continue to be at 121 to 122 over here, while support could come in around, short-term support could be at around 117, then followed by 114 over here. So overall, still very bearish for ComfortDelGroup, given that we actually retest and then failed again. Unless we manage to break out of this trendline resistance at 122, then I think might see some life come into this stock. But even with that, there's also quite strong resistance going at 123 to 127 over here with this long range over here. So I think overall still quite difficult for this stock. Okay, I think we are it's one now. I'll try my best to go through the rest on the Holdings Committee. Yeah, feel free to post your questions over there. Yeah. So I'll hand back my time over to Paul if he has any closing remarks.
Yeah. Okay. Thanks. We'll just try to just cover as much the next 5 minutes. Then we should stop because I don't. You can post the P3 community site if you wish. Yeah. Okay. And let me just run through. Since everyone asked about Comfort, and probably not. And everyone turned even more bearish after watching the chart. But okay, anyway, let me just answer some. Any news on ComfortDelGroup Australian IPO after they dished it 2021? The stock seems like a value trap. Yeah, actually, the IPO plans is probably shelved permanently. I think, especially if you're going to push for transport. I don't think how much valuation upside are you going to get from listing this. So I don't think this thing is on the cards anymore. Help me understand what's causing the big dip in ComfortDelGroup. And okay, let me just run through again our thesis on this. Okay, so for ComfortDelGroup, this is not just an income story, but of course everyone just looks at the P&L, and for us it was also a balance sheet story. So before the pandemic, the net cash was about 70 million. Then post pandemic, it's now almost 600 million net cash. So one of the reasons of probably not so well known is because their depreciation a year is about 400 million, but their capex is only 200 million. Probably confuse everyone. But anyway, what we're trying to say is that this company is piling a lot of cash. It's just that the P&L doesn't look that fantastic because this year they've been hit by the overseas business. I think we highlighted before. Number one, the bus drivers in the UK, they had to pay them higher because there's just so much strikes, and they can only get compensated by the UK government because this is a pass-through business in every 1 year anniversary. The second reason is China also incurred, I think, 15 million or more taxi rebates that they had to pay, and this takes up from the profit. So Comfort makes about probably 200 million. Then this is probably about 8%. So that also impacted. So it's the overseas business that has been the most harmful. I think the Singapore business is up maybe 4 times in the profit. But I guess everyone just looks at the other overhang why the share price was recently. Recently AirAsia announced that they might want to do ride hailing. Again, I'm not sure how they tried to do delivery and it just disappeared. But I think that also hurt sentiment. There's also a few bus tenders coming up, so that also caused some nervousness by the market. So for us, I know everyone looks at the income statement, but for us, we also liked it. I mean, rightly or wrongly, and probably not wrongly now since the share price didn't go up, but because of the strength of the balance sheet. So for us, we were at least we were very attracted to this huge surge in the balance sheet and cash flow. So they generate almost 300-400 million of cash flows a year. But of course, nobody looks at it. Everybody just looks at the P&L and all the news out there. Okay. Should I just recommended SIA easier, although that actually that the balance sheet one was like much worse. But anyway, so we look at balance sheet also P&L sometimes. I mean for this particular stock. So let me just answer one more. The rest we will try to tick it on if you want. Just go to the P3 and post it. So for SRS investment for income tax offset for the coming tax year, what stock would you suggest to gain as well as strong dividend? So for us, the near-term setup is still going to be positive for the banks. Let me just run through at least what has changed the near term. So for the near term, like Glenn mentioned, we think there should be some upside surprise in the dividends. Number one, why? Because we think they will want to push up the ROEs because they see the share price, and to justify it, they need higher ROEs. And by paying more dividends, your ROE actually increase. For those who may not know, because when you pay more dividends, your return, right, the profit over equity, so the equity actually comes down when you pay. So that should raise the third reason is also why we like it is their yield now maybe 5%. Of course, it may not be as attractive as a REIT now, might be 6%, but they have more room to grow by default their dividends than the REIT right now, because REIT is facing interest rate headwind. But for a bank, do remember, no, they're only paying out 50% of their profits as dividend. So there's room for them to grow because they got the retained earnings to grow. So that's the third reason. And there's also the budget coming up. Again, I mean, who knows what's coming up, but there's probably going to be some stimulus to offset inflation. So if that happens, that could also, at the side, maybe be positive for the domestic economy. And the fifth reason is the domestic economy remains strong. So we think all this setup is positive for the banks, even for SGX. So to answer that question for us, I think the banks is the one that is probably still going to be a good bet for this year. Okay, I know there's still quite a lot of questions, so sorry. I think we don't want to drag this to like over 2 hours. Everyone's going to drop off anyway. So we'll try to answer some. If you do have, just go to the community chat here, and then we will try to answer as much as we can. Okay, so with that, I'd like to thank everyone for your questions. And again, you can always just be as critical as you wish about our calls. We will just answer them. We try to be as transparent to everyone. So some of the calls have not been that great. Just mention it and we will try to address it. So we don't try to hide around any bad calls. So we try to be as transparent to everyone as we can. With that, I'd like to thank everyone and have a good week ahead. And thanks for your time and all your questions. Thank you, everyone.